Welcome to TradeTheMBI.com. This is John. This report is for the 12th. And look at that breakout right there. This is exactly what we described. And I also mentioned to you that as this took place, we would also see the NASDAQ break out into its range. Now, it's interesting. You're seeing the early beginnings of a move. Now, we first talked about it at the breakout of the midterm buyers crossing over red, which is right down here. At the same time, the steel, which is short-term buyers, crossed over the short line there of the cyan, and I gave you this entry right back there at the just about 2200 range. Now, interesting, with this setup, there's still a projection now. Okay, well, let's talk about some basic things. Yes, overbought, not typically a problem at this particular stage, especially with the cyan under red. That's indication that we're going to have continuation. Now, I would expect that we're going to reach 23 with this move. Will we have some backfill in between? Potentially, but at this particular point, we're now getting the steel moving below 7.5, which at this particular point would be the exact criteria that you would have for a long signal. Now, this has happened before, and we'd have to go back a little ways to look at the last time we ended up with this type. Obviously, we ended up with similar effects when we ended up with the orange dipping below, and you ended up with it right about here. Was the transition that was at 2084, and we jumped all the way to 2150. So you can see that there's the potential, and we can go back and find several others as you scroll through. If you want to take the time to look through your charts, you can find plenty of these examples and what it should lead to. So that gets very near, and it could go even further. My projection had always been the 2350 range. Is it likely to happen all at once? Probably not. We're probably going to slow down in some of these, but it's still going to be a relative steady climb. I talked to you about the fact that there's plenty of people behind the curve on this. They're going to have to play catch up. The more they have to catch up, the more they have to apply. So that's usually what fuels this. So here's your NASDAQ ultimate high right up here, and we're getting really close to that one. So that's going to lead to an additional move when you get a little breakout above that point. We were sort of right at and cleared the last previous hurdle range, which is right in here. You had that confluence, and then even at the peak move, we're right at that top. So some people will be screaming short at that. We don't have anything in those readings that indicates that that would be the play at this point. And then you can see, of course, the Dow, just juggernaut. Potentially faces a little bit of retrace in between there, and that would be normal to see some retrace in the industrials as people collect some profits from there, move into a little bit of the NASDAQ where there's a little bit of weakness, expecting normalization between the market relationship of those two, and also including the ES as a trifecta for equalizing normalcy, sort of just a mean reversion is the easiest way to describe it. Euro, now again, right back at the same area where central banks have been defending, and this has been taking place for, well, a couple of years. If I shrink this thing, we could see way back, and we've talked about this for quite some time. It was a year ago. They were right back down at this exact same spot, and every time we've gotten there. Now, will they continue to do so? It's going to become more problematic because there is a serious concern as to whether or not in this currency war that's been taking place for several years, the power of this quantitative easing at the same time when the U.S. is just looking to phase out of that is going to create some serious instability as far as whether or not they can sustain. And like I said, anything below that 103.5 range is very problematic for maintaining a euro above 1. And that is very troubling and would be impetus for a little bit of concern on the ES, the S&P, simply because a lot of companies have exposure overseas, and as the dollar becomes stronger, it does put earnings pressure on them. They can't use that high euro as a float to show that they're making exponentially large returns like it did when the euro was in the 125 to 140 range. TLT, as I said before, we've been waiting to just get closer to move down to the ABM yellow level right there, and getting close to it. That's right around that 125. We keep dipping, and we'll continue to follow that lower. I mean, I told you that 113 was what I was looking at. I've been saying this since 140, so anyone who claims that they just weren't sure, should just go somewhere else because couldn't have been any clearer about how that's going to go. Oil at this particular point, the bounce back not totally unsurprising with the potential from OPEC about limiting production, but more of this is also pressure that the potential for a U.S. Resurgence as far as growth from a no-growth policy will cause a significant demand increase. It's still problematic at this particular point. You're not going to see a whole lot of press past where we're at simply because you still have a massive oversupply that has to be worked through, and that's going to take some time. And gold, obviously, I think a lot of this has to do with India's situation, some of it China, a lot of factors not really relevant to the fact that, yes, we still expect it to suffer as it's continuing its decline. We're getting into some really significant shakeout reduction. There's still very limited prospect of inflation. I think those that are still preaching that inflation hawk as well as the bond issue, this is where there could be a slight rebound in bonds, interim, short term, simply because of the potential that while you may have all of this potential idea of growth and expansion, it hasn't materialized yet. And so until it actually does, this 100% likelihood of a rate increase by the Fed, while they may do it, is still problematic. And I don't see how they could do more than a quarter basis points because the potential for upsetting the economy before anything has actually taken place is, I think, far greater, and really puts constraints on them as far as budgetary and fiscal issues. What do you do when you do that and you increase the rate of defaults, blah, 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 blah. It's really problematic because you're not looking at an economy that has been stabilized just yet as far as, the policies. They haven't changed yet. So some of that, there's going to be a lag, and I think it would be probably not so prudent for the Fed to act before anything has taken place as a preemptive. It's not going to be as healthy as waiting to see, because you can always attack it a little bit later. There really is a significant amount of the workforce available to fill in that you're not going to see wage pressures skyrocket to the point where they can't accommodate the slack in the workforce. Now, these get into some macro as well as microeconomic issues, but it's important in relative to seeing what we're looking at in the readings as far as the market is still very strongly posed towards increases. I mean, looking at this 5K, we had the nice buy configuration setup. This has been going on for a few days now, and there's been no change. I mean, we've been staying above the ABM green throughout this entire run. It's not even something that you even had to guess about. It just has been a clean, straightforward run. But I wanted to go over some of those basic economic constructs with you because they do become significant and important in planning out how to perceive short signals in that, because at this particular point, you're not going to be looking at gaining a whole lot as much as maybe clearing a position and then using dips to re-enter until something changes. As always, though, you can take a look for me on the Skype chat.